Hi, everyone. This is Jason Bjark of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. We're recording this interview on Monday, December 15th, 2025. The US dollar gold price, it's up substantially again. It was quite a bit above 4,300, headed to 4,400. It's corrected a little bit before the jobs reports, I think, coming out in the next couple days. I think we're getting two jobs reports, the October one and the November one. The silver price has been on absolute fire lately. It's up to $64. It's just gapped up like enormously, and there's rumors of just insane amounts of shortages and very, very large players standing for physical delivery. Bitcoin price has corrected a little bit down to 86,000, but that's kind of normal over the course of the long term here with Bitcoin going through a lot of volatility, boom and bust cycles, and the stock markets are at or near all-time highs, the U.S. stock markets, at least. Today's special guest is a returning guest, and it's right on point here with the asset prices I just discussed. He released a book over the last 18 months called The Big Print: What Happened to America and How Sound Money Will Fix It. He also runs Equity Management Associates, which is a gold fund, and he co-founded the Bitcoin Opportunity Fund. Lawrence Lepard, thank you for joining me again.
Jason, it's great to be with you. I always enjoy our conversations.
So, Lawrence, the liquidity situation, we just hit before we start recording for listeners out there. So everyone's talking about, deflation and all that. The liquidity, the global M2, it hit $96 trillion
Right.
recently. Like,
New
and
all-time
so,
high.
yeah, an all-time high, 96 trillion of currency and credit just sloshing around. That's M2 all over the place into US capital markets. But I want to get your thoughts on the macro situation because Jerome Powell, and you've been doing this a very long time. Jerome Powell gave a press conference late last week talking about interest rate cuts and not QE, and I'm using air quotes here, like the Chris Farley Saturday Night Live skit, Chris Farley where he has the glasses on and he's doing the animated air quotes here. He's like, he's adamant, it's not QE, but, and then he was like, we need to add like tens of billions of dollars of reserves to the commercial banking system. Does this remind you of the 2019 Repo Madness crisis?
It really does. I mean, it's a little different in the sense that in that crisis, what happened was obviously the repo rate blew out because bank conditions, monetary conditions became too tight. And so they had to immediately respond and flood the system with money. And they stopped. They were doing at the time, they were doing quantitative tightening. They stopped that. They started QE, they cut interest rates, et cetera. So yeah, there's a parallel there. Although in this case, they're trying to get in front of it a little bit. But I must say, as we discussed before we turned on the camera on the recorder, I was really surprised at how quickly and how aggressively this came. I mean, basically, they trial ballooned it. The announcement was last Wednesday. They trial ballooned it about a week before that. You saw Bank of America and Goldman and a few other analysts were kind of talking about, well, they might be talking about some kind of a reserve management thing, which it got leaked to those guys. And they wanted to put the idea out there so that the market get ready for it. And they said, and it might be something in the range of 20, 25, billion dollars a month. And it might be in January. Those were that's the trial balloon. Well, sure enough, we come along, we have the Fed meeting, and it's not 2025, it's 40. And it's not January, it's in 2 days. It's starting.
Well, all our listeners have to do, and I've been showing this on my social media, on my X profile, and I sent it to you, Lawrence, is go to the St. Louis Fed website and go look up reserves in the commercial banking system. And
Right.
despite all that global liquidity, despite asset prices at those levels, I mean, there's serious credit problems, banking system problems. We're back to 2019 levels of reserves in the commercial banking system. So it's huge distortion because of fractional reserve banking and these banks and what private equity, pension funds, insurance companies, I think even were involved in this private equity, in this private credit bubble. Apparently, all these insurance companies are holding a lot of this bad debt.
Yeah, well, there's not only a lot of bad debt and leverage in the system, but as you point out, that we were seeing some strains. I mean, the SOFR rate, which is standing overnight Fed funds repo rate, blew out over the interest on excess reserve rates a couple of times, and then the standing repo facility, which they put in, by the way, after 2019 in order to try and address this kind of an issue, but it hadn't been used very much. That got used a few times as well in the last few months, and they've been trying to signal this, and I think it's very interesting. I had a tweet about this where I just said, what the Fed is trying to do is make it sound like, hey, nothing to see here, folks. No big deal. This is just technical, monetary plumbing stuff that we'll take care of, and you don't have to worry about it. It's not QE. We're not printing money.
They said the same exact thing in 2019, and if I remember correctly, Lawrence, during the summer of 2019, the Repo Madness crisis, when they were saying the exact same stuff, oh, it's no big deal, oh, it's not QE. I think the Fed's balance sheet didn't increase by $1 trillion in 3 months.
I don't have the exact numbers right in front of me, but yes, it started going up quickly. But as you recall, 2019, he pivoted when the overnight funds rate blew out. But then that was only a little bit before COVID, which was March of 2020. And of course, that's when it really got going. But yeah, it went up. I don't have the numbers right in front of me.
Well,
It
we've
went up quite
discussed
a bit
this.
when they did pivot. Yeah.
We've discussed this too, and I mean, you've talked about this with stories with Ken Griffin from Citadel, right?
Yeah,
That the
right.
2019 repo crisis, like the Fed was like, oh, it was people exaggerated it. Like Bloomberg stole my term. They were using Repo Madness all the time within a couple weeks after I started because I had one of the top financial YouTube channels back then, and I was doing these Repo Madness crisis. They papered over way more than was claimed. I mean, there was like I was getting messages from portfolio managers at investment banks in Korea that like basically the credit markets had frozen up, that there was like Goldman Sachs portfolio managers in Korea and Asia like sending me messages that basically the Fed had to overnight, there was emergency like Zoom calls and phone calls that they had to guarantee like credit markets all over the planet. So they didn't actually print the money, but they had to issue backstops that they would print the money, that they were issue guarantees. So there was a ton of stuff behind the scenes. It was way, way worse than the $1 trillion official Fed
Doesn't
balance sheet
doesn't
increase.
doesn't surprise me. I mean, they always try and make it sound like it's no big deal, but I mean, as you and I've discussed so many times, this is just the nature of a system that's based on growing debt. And when your debt is growing as rapidly as ours is and as the world's is, you have to grow the money supply or else you can't service the debt. I mean, we saw it a little bit earlier this year too in another item where, as you recall, Argentina got into trouble and suddenly their currency came under serious attack. And because we wanted Argentina in our camp, not China's camp, we immediately said, oh, no, no, don't worry. Percent came out and said, don't worry. We're going to give Argentina a $20 billion swap line so they can defend the currency.
And that's
Well,
just the official number. Yeah, 20 billion.
yeah,
We
well,
don't
I was going to
know.
say
Yeah,
that
if
then
we
two
do an
weeks
audit,
later,
it could be low.
yeah, 2 weeks later, 20 became 40.
Oh, really? I didn't
Oh,
even know
yeah.
that.
Yeah, yeah,
I
they
only
doubled
saw
it.
the 20. I saw paying
Yeah, no,
attention. I
no,
was
they
like,
said 20 and then it became 40. And for all we know, it's 60 or 80. I mean,
it could be
look,
100. Yeah.
yeah, they have off-balance sheet accounts. They have operators in the Cayman Islands. They've got the BIS. All these
Well,
banks coordinate with one another. We know that,
well,
right?
the large U.S. and European banks are also playing in the currency derivatives market over the counter, and so they could have leveraged bets on bad debt, and they could have gotten bailouts too, because they could have been betting on the Argentinian peso, and they could have been caught with their pants down. I mean, that's happened a lot over the years too.
Yeah, no doubt. And so, I mean, the other things that are going on that I think speak to the problem that the Fed is trying to address, that are really, to me, big signposts in the macro land are, the Japanese 10-year bond is making new record highs. I mean, 3 or 4 years ago, this was almost a zero yielding bond. Now it's approaching two. It's right around 2% a year. And of course, that was a funding source for so many of these carry trades, borrow in cheap yen, invest in carry trades. And of course, that's going away. The other one that's important is that the German 10 years, same thing. It's cruising towards new highs. And the UK gilt isn't exactly looking great either. It's not quite as high as the other two. But the fact of the matter is that the bond markets are coming to realize that they are the sucker at the table. And the reason they're the sucker at the table is that mathematically, when you have a levered system like this, you have to create money. And of course, the other thing I'm sure it's where we're going to go next is that, you've got this administration just, more or less doing everything they can to indicate and make sure that quote unquote more money is coming. And let's talk about what those things are. I mean, one is you put Stephen Moran on the Fed board. I mean, he says he thinks that, we're way too restrictive. He dissented in this last meeting, said he thought the cut should be 50 basis points, not 25. You've got President Trump saying he thinks interest rates should be 1%. We're the best credit in the world, he says. You've got Kevin Hassett, the presumed new Fed chair. Although it's interesting, Warsh is kind of coming along strong because some people have warned about Hassett being too much of a lightweight. And it's interesting, Warsh is also a good friend of Besant. So it's possible that Warsh will get it, not Hassett. But in either case, either one of them, I think, will feel very pressure, a great deal of pressure. I mean, Hassett won't feel pressure because it comes naturally to them. But if it's
Well,
worse,
well, they can't stop the yield curve from steepening, right? Which means a
no.
recession because we had an inverted yield curve. But for listeners out there, when you have a very long time frame of an inverted yield curve and then it steepens, then that normally predicts a recession. But the only way that the Federal Reserve Bank in DC, really, the people planning the economy and government spending, can unsteepen the yield curve is by actually monetizing debt, right, and targeting the 10, 20, 30-year US Treasuries and going out and buying those.
Right. And Bassett's been doing that, by the way. I mean, it's been whether you want to call it an Operation Twist or, QE light, I mean, he has been changing the nature of what he sells. He's been selling, short-term bills, 2 months, 6 month, 3 month, all those things. And he's been using some of those proceeds to buy off the run 10 years. So, it's kind of an Operation Twist. I mean, my view is the 10-year right now is at 4.2-ish, maybe a touch under it. And they can't have that thing get away from them. If that goes to 5 or 6, it's game over. And so, what they're trying to do is try to manage perceptions and manage, the bond market to be calm. But we saw, when Trump did Liberation Day and he croaked the bond market and the stock market both at the same time, if they push the wrong buttons, the bond market's going to break. And if the bond market breaks, they're going to have to come in. And, it's funny what I said when this whole thing happened last week. I put out a tweet and I said, well, here we go. The big print is starting. And my good friend Lynn Alden said, well, I call it the gradual print because she's right. I mean, 40 billion a month, while it's a lot in old money terms, today it's less. So it's, 480 billion a year. I mean,
Well, they
the
want to
last
fight
two,
deflation, though, right? Because I think the important thing is that they've come out and said basically they don't want to allow deflation.
that's right. That's right. The underarching theme is they will not allow deflation, but I don't think there's much risk of that. I mean, if most people who go out and buy things in the world today know inflation's not running at the 3% they claim it's running at. I mean, meat, insurance, there are a lot of things that are running well above 3%. And
Well, the
so
necessities, yes, but then the discretionary items, does the consumer have the credit or the purchase or the cash flow, the free cash flow, the monthly income to go buy discretionary items? So it's just created distortions, like you said. So the necessities, if people want the same lifestyle, they want the normal lifestyle of healthcare insurance, car insurance, they want to eat the same amount of food, the same type of calories, eat at the same restaurants or grocery shopping. Like those things are up, but the discretionary items with the distortions, those things may fall because there might not be credit or demand for those.
no, it's absolutely right. I mean, you've got, it's the worst of all worlds. Assets and certain things could fall in value while things that you absolutely have to have, like food, are increasing in price. So it's a K-shaped economy. I mean, yeah. I mean, I've seen statistics that show that, the top 10, 20% of the country is doing all the buying. I mean, most of the country is just living, on the edge, subsistence wise. I mean, we've all seen the statistics. Most people couldn't have come up with $400 for an emergency. So it's really a rather sad set of, circumstances, Jason. But I think that what we can all take away from it is that mathematically they have to print more money and they will print more money. And so while I deeply respect Lynn and her book and her view that it's a gradual print today, I think the gradual print is going to morph into a big print
Well,
because
let's see who gets bailouts because I hope I'm wrong about this, but Sam Altman was in DC,
yeah.
working his lobbying angle with him and his lobbyists, trying to make sure he gets bailout money from both houses of Congress. So that's OpenAI for listeners out there. And so like they have the largest, OpenAI has the largest cash burn rate in Silicon Valley history. I mean, like it's the numbers just don't work for capex projections. They don't have a growing amount of paying customers. They actually have large amounts of cancellations. They get hit with all these capex bills. It's not, the business model is not scaling. Actually, they don't really have a business model right now. They're kind of doing innovation, and even now it looks like Google and Chinese companies are surpassing them.
Yeah, that's right. I mean, as we talked about pre-show, I mean, I think that, the what's going to happen, and it's interesting because, David Sachs, the crypto czar, came out and said, well, no, no, we're not going to. I mean, Altman implied that he might need a bailout or might need a government backstop, and Sachs said, no, 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 we're not going to do that. It's everyone's going to have to compete on their own, which is the right thing to say. But as a practical matter, I think there's a certain amount of thought in Washington, D.C. and just in, the U.S. in general that we are in an existential fight with the Chinese over AI. And so it would not surprise me at all to see, I mean, and China pursues industrial policy. It would not surprise me at all to see, the U.S. pursue kind of quote unquote industrial policy and help some of these people with their capex or with guarantees or whatever it might be. And of course, there are those of us who would scream, "Hey, this is just like bailing out the banks in 2008." But the counter from the other side would be, "No, it's not. This is strategically important, and we can't afford to lose this race."
I
So,
mean, yeah, like you said before we start recording, and I've heard this mentioned too, like unpublicly, like national security, that's like kind of the blanket, like, oh, national security.
right,
Well, I mean, that's a really vague term. I mean,
right.
why not let Microsoft or Meta go and buy OpenAI, let the valuation for OpenAI collapse, and then Microsoft and Meta, who are better run and have profits and free cash flow elsewhere from other parts of their business, they can go buy OpenAI, and then we don't have to give a bailout. It's just sad how corrupt things are here in Washington D.C. with both political parties in Congress and in the White House.
Yeah, it really is. I mean, it's there's no responsibility left fiscally or otherwise, and so. And really, the stock market has kind of become a policy tool, and this is why, Trump and Besant and his new Fed governor Moran and potential additional Fed governors, they know very clearly that they have got to get the cost of capital down. I mean, as you and I both know, the interest expense right now in the U.S. federal government is running at over $1.2 trillion a year. It's almost the largest line item, and as a result of that, they could reduce their interest costs a great deal if they could get interest rates down, and that's fine. I mean, bringing interest rates down at the short end would be fine. I mean, in a sense, but it will lead to money supply growth. It will lead to more borrowing. It probably will lead to more steepening on the long end because everyone knows that M2 will accelerate and grow, and then of course that's going to have to lead to yield curve control because, as we discussed earlier, you can't have a 5 or 6% yield on the U.S. 10 year. It just doesn't work. And so, I see a lot of inflation in our future. And I see, I've said many times, this decade reminds me of the 70s. We were going to have waves of inflation. COVID came, we went from 0 to 9. We've come from 9 to 3. These are the stated numbers, which are inaccurate, but
Oh,
let's,
they printed way more money in from the 3 or 4 years from 2020 to like 2022, 2023. Way more money globally was printed than people realized, the money supply growth.
absolutely. And so, so now, okay, so Powell tries to be Volcker for a while. He wasn't successful at it, but he did get the rates to come back down. And there was a time, if you look at the chart, you and I both looked at it, where M2 actually did decrease slightly. But of course, that's just not sustainable because you've got to have growing money or else the debt collapses. So, it's a real mess we find ourselves in. And as investors and citizens, I mean, I think there are two things we can do. One, we can protect ourselves in terms of what we invest in. We can invest in things they don't print. And then I'd say as citizens, what we can all do is we can lobby for and advocate for sound money and for a return, a reset and a return to sound money, a gold standard, commodity-based standard, Bitcoin involved in some way, whatever. But some form of sound money is an absolute necessity in a balanced budget, or else this thing's going to run off the rails. I mean, it's already kind of running off the rails. It's going to get worse.
Well, yeah, you mentioned Japan. I mean, all these big economies, whether it's China, European Union, Japan, the US, they all look in bad shape. Do you think that Japan's going to have to sell US Treasuries, a large amount of them, in the near future to defend their currency or save their banking system? Or do you think that they're going to come up with some other type of creative financing? Are they going to use that other permanent repo facility? Because there was two that were created in early 2021 for central banks. Are they just going to put their treasuries as collateral? They just going to draw a swap line? What do you think is going to happen with the US and
Yeah,
Japan?
it's a fascinating question, right? Um, Look, the optics of them selling their treasuries would be really, really bad. And so I just kind of wonder, I mean, and we're at the stage now where, they're holding this thing together with, baling strings and wax. I mean, it's a real mess. And so you mentioned swap line. It would not surprise me at all if there's kind of an off the record swap line between the US and Japan, wherein we are lending them money to buy our treasuries. And somehow that's not even getting reported anywhere.
Well,
I mean,
well, actually, let me add to that, Lawrence. So a lot of listeners don't know, and there's an old speech that on the Gold Antitrust Action Committee website from years ago, there was a vice president at the New York Federal Reserve Bank, and he actually said that as part of the G7 agreement post World War II, during the Marshall Plan and others, that the G7 countries, they all don't have to declare this. They have ironclad currency swap arrangements with the G7 central banks. They don't even have to announce it publicly.
yeah,
So
it
he
doesn't.
said it in the speech. It's an old GATA article. You can look it up on the Gold Antitrust Action Committee website.
Yeah, that doesn't surprise me. I mean, it's what, Jean-Claude Juncker said, when it gets serious as a central banker, when it gets serious, you have to lie. And
Yeah.
right.
Well, there's been a lot of that since 2008.
Yeah, and you can bet that right now it's serious. And so but my sense is the problem is too large to sweep under the rug, and that eventually, what we're seeing, I mean, I'll tell you what's telling you, Jason, that I'm right about that are the price of the precious metals, right? I mean, look at, what's happened to gold and what's happened to silver, basically since Doge failed. I mean, everything was somewhat contained. When Trump came in and he talked about, all right, we can balance this budget, and Elon said 2 trillion, no problem, which is a joke. And they said 1 trillion, no problem. Well, of course, at the end of the day, what do they say? Maybe 50, 100,
I think they got 200 billion if you count some of the contracts that were going to go into effect and they were canceled. So
Okay.
we'll give them 200 billion.
So
So
if you
that's
give them
still
200, they're running a 1.8 deficit, and you give them 200. And then, correctly, in my view, I think the tariffs are actually a smart thing. I think, putting a tax on consumption, particularly foreign consumption, in order to, reshore a lot of our manufacturing, I think it's a good idea. Um, it wasn't done really gracefully. I mean, he went too hard and things collapsed, and he backed off. But the tariff revenue right now, I think, is running about $30 billion a month. So that's 360 a year. So that's really good. So you would think to yourself, okay, Doge cut a little bit out, the tariffs cut a little bit out. And I know the Senate just bragged about how good this month was deficit wise versus the prior year. I don't know that it's all very lumpy, and so I'm not sure that really matters. But we need more data to see. But yes, they brought in some more revenue, and they could cut some expenses. The problem is Congress turned around and passed the big beautiful bill this summer, and all those Liberty Caucus people and et cetera who were determined, to make things tougher. Trump bullied them, and they caved. And the only two who hung on were Thomas Massey and Rand Paul, and of course he's demonized them as being
yeah, he wants to
anti-American.
fund their opponents in
Yeah,
elections, right?
exactly. He wants to primary him and get him out of there. And so, what does the big beautiful bill mean? Well, the big beautiful bill, depending upon who you believe and how you score it, is between 300 and 500 billion in additional spending every year. So, okay, yeah, we're getting tariff income. That's good. Maybe we dozed a little bit out of there. That's good. But we turned around and we committed to spend more in the big beautiful bill. So, I
Well,
mean,
for the record, I'm not in favor of the tariff income, but I think they put it in place of like a VAT tax because what half the country, 50% of the Americans don't pay an income tax. So they
right.
put that in. So it's like they're trying to figure out ways to tax people, but it's disproportionately hurt middle class consumers or lower class consumers, and in small businesses the tariffs have, and then what these large corporations got exemptions, so that hasn't helped the economy either. You add in what HBN1 visa applications and artificial intelligence software, the company switching over, and that's causing what a lot of job losses in the real economy.
Well, that's right. And that's going to represent a problem as well. I mean, you think we've got trouble now. I mean, it's very hard to predict how AI will affect the employment picture, but I don't think there's anybody who thinks AI is going to increase the demand for employment. I mean, it's
Well,
clearly, I know.
maybe 10 or 20, 10 or 15, 20 years from now, it'll create new industries. But in the short term, yeah, I agree with you. Creative destruction. I think there's going to be a lot of job losses.
Right. And so once again, in a highly leveraged economy with a lot of debt, you start running up unemployment and job losses. And I mean, that's what's so troubling, Jason, that, we're running this $1.8 trillion deficit right now. We just finished the September year. And, the stock market's at record highs. Employment is basically healthy. We're not, I mean, there's nothing has quote unquote really gone wrong. I mean, and so we get a lot of tax income off the capital gains from those stocks. So, what happens if and when, heaven forbid, the stock market rolls over, or heaven forbid, the employment market rolls over as a result of AI slowing down? We could see a real nasty, nasty situation where, you're going to have a lot more in social costs, and you're going to have less revenue, and a $1.8 trillion deficit, which is about 6% of GDP, could look like a 12% deficit, like what we had in '08 or what we had in 2020. And
Wouldn't
of
you
course,
say
that
that a lot
all
of
of those deficits represent strain on the bond market. And we already know the bond market is under strain because they just addressed it by printing more money. So, I
Wouldn't
mean,
you
it's
say
kind
the
of
rise in the stock market, though, the rally, it's not necessarily because of AI, although big tech big tech does have good profits, but the other 493 companies in the S&P 500 are not doing well. So it's just what the Mag 7, the big tech companies that are dragging the index higher. But wouldn't you say that the stock market is rallying because of that global liquidity, the M2 at an all-time high, 96 trillion, give or take, right now globally, and then also the weak dollar. So that's also factoring into higher asset prices.
I think that's right. I mean, I think the stock market is rallying because people basically, buy the dip and, in a crack up boom where there's more money coming into the system, there's a lot of indexed money that just automatically goes into the stock market. Doesn't necessarily mean it's good value. It's very, very, very overvalued on any historical metric. But, if we're going to continue to print money and part of the policy choice is that we're going to print enough to keep the stock market going up, well, people aren't stupid. They're going to buy and hold the stock market, and they've been rewarded for doing it. So, and I'm not saying that's going to change anytime soon. I mean, I've lost plenty of money trying to take short positions in the stock market because it's overvalued, and I've stopped doing that. I prefer now just to bet on, the inflation that will come as a result of all the growth in the money supply, and
Well,
that's
you can make an argument that the best short on the stock market or other things has been gold. So if you're a foreign central bank, you're probably not buying U.S. stock market shares. You've been
well, that's
dollar
right.
cost averaging gold for the last
That's
increasing
exactly
amounts.
right. I mean, if you don't believe in the stock market, the best way to express it, in my opinion, is to buy gold or silver. Because they're going to benefit from the same monetary debasement and they'll benefit even more, and they're not historically overvalued if you look at them compared to central bank balance sheets or money supply or a lot of other things. I mean, I've got one study that shows that if we went back to the method we used in the 70s to divide the money supply by the number of ounces we own 261.5 million ounces allegedly. Gold should be $90,000 an ounce, and it's not. So and that I'm not suggesting we're going to go there. We're not, obviously, but what I'm trying to point out is that's how much paper money has been created. There's a lot of paper money out there, and gold is anti-paper. Gold is the thing you turn to when you lose faith in the system. And what's going on, I think, based on the failure of the general failure of Doge, the general inability of Congress to control spending, et cetera, is that people are losing faith in the system and losing faith in the currency. And it's just math. It's not really even a judgment call or a political issue. It's just mathematical. The money supply has to grow or the thing will collapse. And, look, they could let it collapse. I mean, that's 29, okay, fine. We're not going to continue to expand the money supply. Let's let everything collapse. But I think the average politician faced with let it collapse versus deal with inflation later will always choose deal with inflation later.
Oh, governments hate deflation. I mean, there's a
Right.
good Mises Institute article about the politics of deflation. I mean, that means that asset prices fall, companies fire employees, tax receipts, whether that's consumer spending in the real economy at restaurants, bars, shopping, or capital gains taxes, those all collapse. Property taxes
Yep.
collapse. People can't pay those. So politicians generally over the last 150 years, they hate deflation.
Exactly. And so, and I talk about that a lot in my book. I mean, deflation's a good thing, but I mean, rapid deflation is not a good thing, but mild deflation as a result of increased productivity is a very good thing. But, Keynes, and governments have ignored that, and they've done it because it keeps them in power and makes people who are close to the money printer rich. I mean, these are the people we call cantillionaires because they're able to borrow cheaply and buy assets. And the rest of us have to go, I mean, I was just talking to a guy who's running for Senate up in Massachusetts, a guy named John Deaton, really good guy. He's going to take on Markey. He might have a chance of winning. And one of the things he wants to do is install usury laws. I mean, there are credit cards now, Jason, that are like a 35% rate of interest. I mean, and everyone says, well, yeah, you got to have that kind of rate to take the credit risk out of it. No, no, no. You just shouldn't be allowed to do that. I mean, that's the mob, right? I mean, somebody borrows money at that kind of a rate. I mean, they're never going to get out from underneath it. So,
Well, they were calling bankers in 2008, the financial crisis. Remember, there was Occupy Wall Street. They were calling them banksters. So there was all
oh
those
yeah,
bankster cartoons back then. But
yep.
then that kind of died. That kind of went away after a couple years. The bankster people calling them banksters. So, but now they have what payday loans, all those things, and then
Oh yeah.
the really high interest credit card debt. even
Well,
though it
and
shouldn't.
yeah, and pay over time on a lot of goods and services, more of that than there used to be. Yeah.
Well, I mean, they're doing buy now, pay later. The younger millennials are doing buy now, pay later for like fast food for Chipotle burritos.
Yeah, I
And
heard that. I couldn't believe that. That seems crazy.
well,
Yeah.
they don't, that's because they don't teach investing or personal finance, business classes, or entrepreneurship in schools K through 12. They teach you how to be a good socialist, and
Yeah.
they
Well,
don't teach.
speaking of which, and yeah, and the people in New York have figured that out, and they elected a socialist, and I think they're going to be sadly disappointed that he can't deliver what he's promised. But that's the problem when you have a system that's this broken. You're going to ping pong back and forth between two sets of crazy policies. And I mean, as bad as this administration is in some respects, in other respects, it's not as bad. And I fear that in 4 years, Team Blue is going to win, and they're going to look at all the gold and silver guys and all the Bitcoin guys, and they're going to say, "Hey, you're ruining our beautiful monetary system. We need to tax you at 90%." Right.
I think
So,
there'll be people leaving the country by then. I think
well,
people will
that
be.
very, very possible, and that's one of the great use cases for Bitcoin. It's a lot easier to take a lot of money out of the country in Bitcoin than it is in gold. The gold big and heavy, but yeah, I mean, the thing is in trouble, and it's kind of falling apart, and it's rather sad, but it is what it is, and it wasn't any one particular thing that did it. I mean, it wasn't 1913, or it wasn't 71, or it wasn't Glass-Steagall, but it was a cumulative number of things that have led to where we are today.
Well,
And
I would also argue that the gold price has really started to move after the Russia sanctions. So you
well,
saw
that's
the
right.
amount of monthly gold purchases, they about doubled. So
Yes, that's
basically,
right.
the countries have taken the philosophy that if we piss off DC, they can just freeze or confiscate 300 billion in reserve assets of Russia, and their interest payments on their treasuries were taken and used to fund the other side of the war. We can't trust DC anymore because they just do bad policies, or if we piss them off, they'll just put sanctions or steal our assets. Or do regime change, like it
Yeah,
looks like Venezuela now.
yeah,
Looks like there's going to be
exactly.
full regime change soon.
Yeah, I think you're absolutely right. You're spot on. I mean, that's the reason why gold has been doing so well, particularly vis-a-vis Bitcoin, which is an alternative form of sound money, is just that there's such an enormous sovereign bid for it, and people understand it and trust it more than they trust Bitcoin still. So it's really quite extraordinary. I mean, gold, I think, is up 64%, this year. I'm not sure it's ever had a year when it did that, or maybe the one year in 79, 80 when it went from 500 to 800 briefly, or 400 to 800 briefly, it did as much. But the point is, it's quite extraordinary. And what it tells me is that we really are watching a changing of the guard monetarily, and the dollar and fiat currencies are now in the pretty advanced stages of failing. Um, you know,
I want to ask you now about gold
sure.
stocks relative to the
Oh,
gold
sure.
price. So you're a gold fund manager.
Yep.
You've had outperformance years where you made hundreds of percent returns. You've had years where gold hasn't done well and you've lagged. Are the gold stocks starting to price in the gold price at 3,000, 3,500, $4,000 an ounce gold? Or do you think a lot of these gold stocks are seriously lagging the net present value of future discounted cash flows close to the current spot price of gold?
It's a great question, Jason. And there's a little bit of a complicated answer. Okay. So a year ago, let's go back a year ago. A year ago, gold stocks were just criminally undervalued. I mean, it was just insane how cheap they were. Okay. Most of the major indices and my fund are up about 150% this year. So more or less, the things that I own, that my fund owned, have doubled in value this year. So, one would naturally think, okay, therefore, they're not as cheap anymore, and they're probably not as cheap anymore. I mean, but one of the things that happened at the same point in time is that the gold price, went from the 2,600 area to the 4,400 area. And a lot of these companies have big capital expenditures, which, produce streams of gold for 10 years at rates which are reasonably well fixed. I mean, they go up with the cost of electricity, the cost of explosives, the cost of labor, but that tends to go up like 10% a year, not 65% a year like the price of gold did. And so the margins are just insane right now. They're all making a ton more money. And so, the answer is obviously they're not as cheap as they were a year ago on an absolute basis. But my sense is they're still on the cheap side of the ledger because of the growth in the earnings and the operating leverage that they have. And trust me, there will come a day when they will not be cheap anymore. I mean, I look at them in a lot of different ways. You can look at them compared to PNAV. You can look at them compared to a multiple of EBITDA. You can look at them compared to the resources in the ground, lots of different things. But they're still on the cheap side of fairly valued. Not as cheap as they were a year ago, but on the cheap side. And that's if gold stays at 4,400. Now, if they go back down to 2,500, well, then they'll be more expensive, obviously. But in my view, is gold's going to 8,000, so they're still pretty damn cheap. I guess to answer your question, I feel very, very confident that if you look at this as a baseball game with 9 innings, potential to go into extra innings, but let's not count on that. I think we're in about the third inning, second or third inning. So my fund did well this year, but I'm pretty sure it's going to do very well next year too. Now, at some point, I'll tell you what, when everybody and their brother is talking about gold stocks, and the Shoeshine Boys recommending gold stocks, when my fund is up another 200% from here, and things are trading at 20 times EBITDA, and they're doing stupid acquisitions and all the kinds of crazy shit they did in 2010 and 2011, okay? At that point in time, they won't be so cheap, and I might actually be selling them a lot. Even though I fundamentally believe in that this is a 10-year, bull market for gold. These things breathe, right? They go up and they come back in, they go up and they come back in. And so,
Yeah.
I still think we're in the period of they're going to go up. They're still cheap, and they're very likely in the next year to go up. But when they double again from here, mezzo mezzo. I mean, I'm not going to be pounding the table like, oh my God, these are insanely cheap. They'll be cheap if gold goes to 10 grand, but we don't know that for sure, right? I mean, I think it's going there, but getting to 10 grand, in my view, could take a few years. So,
Well, I have people asking me for long-term price targets for gold and silver because they're up so much. Be like, is this it? How much higher can they actually go? And I'm just telling them, like, look, if the Japanese yen, if they're going to monetize all that government debt and the Japanese yen is going to go bonkers and they're going to do an insane amount of QE or increasing amounts more of QE monetized debt, the US is going to cut interest rates and do bailouts for OpenAI and a bunch of other bailouts for the data center companies, bailouts for that. And then they're going to also, fund a lot of other government programs and spending, run huge budget deficits, devalue the dollar. And then the European Union and China are going to do similar types of debt monetization for government bonds, just create currency. That's probably why the global M2 is where it is, right? There's a lot of debt monetization and bailouts hidden. That's why the number is parabolic and why the liquidity ends up here in the US. If they're going to keep doing that, we can't set a long-term all-time high price target for gold, saying once gold is at 6,000 or 7,000, then that's it. There might not be a long-term price target. You tell me when the governments are going to stop this
well,
reckless behavior.
yeah, that's the hard thing, right? I mean, so like if they were going to stop it now, maybe it's fairly priced, or I easily see gold at 10,000. I easily see silver at 100 to 150. I mean, I feel like those are falling off a log, likely to happen in the next 12 months, 18 months at the worst. Beyond that, though, tell me what the government's going to do. How much money? I mean, these numbers could go to infinity. Now, the problem with that is that, gasoline will be $1,000 a gallon too. So, I mean, that's really, we're talking massive hyperinflation, currency failure. That's not my base case.
Well, the conspiracy
Yeah.
theorist in me is like, that's probably why they're anticipating doing the bailouts for this, and that's why they're gonna go take the oil from Venezuela.
Well, there's no doubt they want to keep the price of oil low because oil is a big component of the inflation statistics. So, I mean, and the good news is that, what I've read about the oil industry, they've really gotten so much more efficient. They're just really, really good at finding oil everywhere and at fracking and the modeling and all. I
Well,
mean,
but
so
they're
I'm
running out
not.
of the tier one acreage though in the Permian Basin. So I think that's why they're starting to panic is yes, they've improved the technology, but there's only so much high
I agree.
quality, low
I
cost oil
agree.
reserves in the Permian. And so once we're through all the tier one in the Permian Basin, then we're onto a deep water and that's substantially higher cost oil.
I totally agree with you. I completely agree with you. And I don't dispute that over time the price of oil is going to go up and that oil is relatively cheap right now. I'm just I'm more with Doomberg on this where that I think that I think they're if you want to play inflation, you believe in commodity inflation, I think they're easier plays. I think gold and silver are probably the easiest. I think copper is in there probably as well, based on all the AI build out and the building going on in China. And these things have been structurally underinvested in for 10 years. I mean, that's the big thing that people don't realize. And this is why people say, well, how far could these gold stocks run? Well, I mean, let me just give you an example, a data point. I mean, it was in my most recent quarterly report, which is on my website and it's free. You know, I think about 60% of the country, they looked at Bank of America looked at brokerage account, but 60% of the country has effectively 0% allocation to gold. I mean, zero. And, and then the other 40%, I mean, the number of people that have more than a 10% allocation is like 10%. So, if people come to realize that gold is really performing better than everything else, which this year it has, I mean, gold stocks have and gold, they both beat the stock market by quite a bit. There's a lot of money that can come into this. I mean, let me give you another data point. Morgan Stanley, as you know, forever and ever said 60% stocks, 40% bonds. That was the model that they had. This year, and this shocked me, it must have shocked you when you saw it too. They came out this year and they said 60% stocks, 20% bonds, 20% gold. They were
And
talking
Gunlock
about
said more than that, and he's a bond fund manager, Jeff. But Jeff
Ryan, Gunlock,
Gunlock's a
same thing.
libertarian, though. Jeff Gunlock, he
Yeah.
has a small gold fund, and he's a libertarian, so he's seen, the global M2 and what these other governments besides the
Yeah.
U.S. are also doing with government bonds, and he's just shaking his head.
Yeah, he gets it. But here's my point. I mean, I think there's $7 trillion+ in the Morgan Stanley financial, network of client money that's being managed. And somebody did the math and said, gosh, if 20% of that, all of a sudden came into gold, which of course it won't, but if it did, the price of gold would have to go up 30 or 40% to accommodate that move. I mean, and so my point is, we're still kind of early in this whole transition period. And I think, we're not talking about a 1 or 2 year flash in the pan here. We're talking, in my view, about a secular trend with currency failure, monetary debasement, government, malfeasance that's going to take, 2 to 10 years to figure out. And so, now don't get me wrong, there is a risk to this trend. The risk is that government gets responsible. I always tell new investors in my fund, I say, what could go wrong? I say, what goes wrong is if the government starts getting responsible and balancing the budget. They laugh, they howl, we all do, okay? But stranger things have happened. You know what I mean? And
Yeah, I mean, things are headed towards MMT with both debt monetization or
right.
a version of MMT with basically both political parties here.
Well, that's right. Well, and UBI, and I mean, we haven't talked about it. You see Trump saying, well, we're going to give everybody who makes less than 100,000, $2,000 stimmy check. I mean, so we've already tested the stimmy thing, and we know everybody likes that, right? I
And then the
mean,
$1,000 childbirth savings account or
right.
investment
There's
account or
that.
something.
There's that too. Yeah. So, and it's kind of like these are all fun things to hand out to voters, and maybe you get votes that way, but they don't increase the fiscal responsibility. They don't make the currency sounder, right?
Well, but
So
if you're a central banker and in the past you're running a trade surplus, you have foreign exchange reserves, and you would recycle it into U.S. Treasuries, and you're seeing Trump say all this stuff that we're just going to print money, we're going to do bailouts for OpenAI, we're going to bail out all the data center companies, we're going to give like every child born an extra $1,000. You're like, okay, I'm going to be dollar cost averaging gold each month. That's what the central bankers
And
are
that's what
saying.
they've been doing. That's exactly what they've been doing. Yeah, no, they're not stupid. They've been doing that, and totally understandably so. So yeah, it's until I see a change in those trends, I'm of the view that being in sound money assets is the right place to be, the highest probability of an asymmetric return. And that, if you don't want to take the risk of the stocks, I mean, you can just own the metal, you can own gold, you can own silver. If you want to take the stock risk, that's fine too. Those can, they can multiply the returns, but stocks are stocks. I mean, the company management teams can screw it up. And then, of course, over on the side, which some gold people like, some don't, I happen to like, there's Bitcoin, which I believe is kind of emerging as digital gold. And even though it's kind of in the dumps right now, or people think it's in the dumps, I think that, when I look at the important metrics on Bitcoin, the number of wallets continue to grow, adoption continues to grow, use cases continue to grow, and the power of the network as measured in the global hash rate continues to grow. So
I
unless I
think what a
see,
lot of new people that are coming into Bitcoin, Lawrence, sorry to interrupt you. I
that's
want to
right.
add to your points here. I've been covering Bitcoin for the listeners out there who are new to my channel. I've been covering it since 2011. I'm friends with Trace Meyer. I knew Trace Meyer before he joined the Cypherpunk email list and bought any Bitcoins. And I could tell you, like every 3 or 4 years, when people would give higher price targets on Bitcoins, going 200, 250,000, stuff like that, it tends to go through, huge correction. It looks like we're in a
That's right.
correction, but Bitcoin goes through, Lawrence, you've been through these cycles before, boom and bust
Yep.
cycles about every 3 or 4 years, like clockwork. We wipe out a lot of the weak hands. We bottom out somewhere substantially lower than the all-time high, and then it goes sideways for a while or in a trading range, and then it rallies again.
I think that's exactly right. And we're just seeing another one of those cycles take place right now. And, I don't know if we're at the bottom here in the 80s or if it's in the 70s. I don't think we're getting to 60, but honestly, I don't really care because I don't trade it, and I take a very, very long-term perspective. And looking at the power law and some of the other good things that I outlined in my book, I have a very high level of confidence that, come a year or two from now, it'll be at 120 or 150 or 200, and it'll just continue to kind of grow because the all those other metrics I talked about, wallets, usage, addresses, hash power, they're all growing. And so and if they were to stop growing, I could accept it. Hang on a second. Maybe people are losing interest in Bitcoin. It's not working. But I don't see any of that. I see everything I look at, all the indicators, the usage indicators, and what I call dogs eating the food. There, there are more dogs eating the food. So, all right,
And
that's
there's a halving coming up next year, right? And is there one this
yeah,
year?
right. Well, is it next year or is it the year after? I don't remember when the next one is, but yeah, I mean, yeah, and at some point the amount coming out is going to be scarce. Although, honestly, the issuance right now is at 0.8% a year is pretty low, and that used to kind of drive the 4 year cycle, and I think the 4 year cycle is kind of dead. I think it's much more now driven just by speculators and people getting levered up. I mean, one of the things that I think has made the price pretty soft right now. I studied it, and there's some people who look at the stuff on chain. Just like gold and other things, there were a lot of levered players and a lot of paper Bitcoin that got created in the last year or two.
Well, especially
When
with
the
the Tether stuff, yeah, too. I
well,
mean,
there's
like
Tether and
I can't really understand all the stuff that Tether's buying. I mean, they're buying a bunch of gobbledygook.
yeah, they're buying gold and they're buying a football team and yeah, a bunch of stuff. But yeah, I mean, it's like that's a whole different story. I'm not a bear on them like some people are, but the point is that there are fiat games. I mean, and this had to happen. I mean, Bitcoin has now entered the mainstream. We have a huge ETF or two, and they're going to continue. It's going to continue to test people, and as you say, the weak hands will get shaken out, and there'll be people. There'll be some high profile people who said they've sold recently, and okay, fine, you're entitled to do that, but when do you, okay, and I think they believe in it long term. They think, well, I'll buy it back cheaper. Well, when? And first of all, you sell it, you got to pay 23% capital gains tax if it's long term. And then second of all, you might not get a chance to buy it back cheaper. And one thing that's interesting, and this, I think you like these statistics, Jason. I found this by reading a great book called Bitcoin 1 Million by Fred Krueger, which I highly recommend. If Bitcoin went up 800% between 2020 and 2026 or 2024 or 5 kind of, so 8x, right? If you miss the top 10 days, you were down 23%. Isn't that amazing? I mean, it kind of trades like a wild animal with what Bitcoiners call these God candles. And so, someday, like I think there are a lot of people right now looking at it at 80 something and saying, well, if it gets to 60 or 70, maybe I'll buy it. And they don't. And it gets to 60 or 70 and think, well, it's going to 50 or 40, whatever. They're going to wake up one day and it's going to be 110 going to 130. And
It's
then when
mentally uncomfortable being a contrarian, buying when there's blood in the streets. But I
that's
mean,
exactly
you've
right.
done that. You've done that over a career with your gold stocks. I mean, you were buying stuff. We were having discussions in the past. You were
Yep,
talking about producing gold companies at one time's cash flow, and now they're up enormously.
exactly. And it's painful when you're doing it, but if you know what you own, understand the underlying in it, and you're willing to be patient. And that's the biggest thing, Jason. I mean, I caution everyone who's listening to this is I am not a trader. I am a very long-term fundamental investor that believes in compounding. And so, and whenever I recommend Bitcoin to a friend, I say, look, and they say, how much should I buy? I say, here's the test. Buy the amount where if it went down 50%, you wouldn't freak out and you'd be thinking to yourself, oh, great, I get to buy more cheap. Instead of, oh my God, I made a mistake, I got to sell it. Because it's gone down 50% plenty of different times. And it may do it again here. I mean, the high was 120. Maybe we'll get to 60. I don't think we will, but we could.
Yeah,
And,
it's very difficult to pick exact tops and exact
yeah,
bottoms. So
exactly. Who knows? And my view is, at some point in time, if gold does a blow off here into the 5,000s and a few more of my gold stocks go up 3 or 4x, hey, I may sell a few of those to buy some Bitcoin at 70 if it gets there. I don't know. I
for
mean, so
commodities investors, it's just easier though to tell when it's a good contrarian buy because platinum and palladium up until the rally the last 6 or 7 months they were trading below the production cost. I mean, you could have gotten
yes.
platinum and palladium sub $1,000 and no one wanted. I mean, I was interviewing Rick Rule and Alden, Greg Weldon, a bunch of other guests about platinum and palladium miners back then. The miners were in trouble because they were running at losses and it was below the cost of production. People were like, no, I don't want it. I don't want it.
Yeah, no, that's exactly That's always the way it is, right? And yet everybody who bought in that time frame is now probably up 100%. And honestly, I mean, as I said about
Same
the
for silver. I remember it was silver. Like I'm sure you like silver sub
I
25. I
love
mean,
it.
like I had people sending me messages like entire pages. How dare you say anything nice about silver? How dare
Right?
you interview silver experts? Like literally writing me manifestos, like not calling me names, nasty stuff.
Yeah, no, that's exactly right. And yet here we are. And the thing that's a little tricky here is, I mean, you missed the first part. I mean, people coming in. I mean, I've had a lot of friends call me up. I mean, I've been talking about this for 5 years, so it's not like I've changed my view on any of these things. But of course, they all knew I was the gold and silver guy, and so they called me up and they're like, "Oh shit, you're right. Should I buy them now or am I too late?" And answering that's a complicated question. Well, you should have bought them a year or two ago when I told you, but that's okay. You didn't do that. And my view is, you should average into them now because I still think we're in the third inning. That's kind of how I see it.
I want to ask you about geopolitical risk. So the
Sure.
producing gold and silver miners, what their gross profit margins are around 50% and at an all-time high, close to an all-time high. I think even better than the
Better in some
1970s bull
cases.
market. Yeah, because the
Yeah.
energy prices are weaker now.
Right.
So I want
Yeah.
to ask
No,
you
I mean,
about geopolitical risk. Which countries do you think are safe to invest for mining? Which ones are you looking at for opening up? Are you starting to look at Bolivia now, since it looks like Bolivia may install someone similar to Javier Milei, or are you avoiding certain countries right now for geopolitical risk reasons?
I've never been a Bolivia fan, although I've got some friends who are, and it may work out okay. I've never been an Ecuador fan, although Lundin has made a ton of money there. I actually am more positive on the African nations than most people. I don't think the problems there are as bad. A lot of people avoid miners in Africa. I mean, I'm kind of with Rick Rule in the sense that, actually every single jurisdiction is risky because these things are going to be just money pots, right? I mean, and cash flow streams. And so, the temptation, I mean, even the Canadian government, the US government, the Australian government, generally considered safe jurisdictions. I mean, they're going to want to tax these things or put royalties on them or maybe even confiscate them, in a national emergency, right? So I'm not sure there's ever really any safe jurisdiction for miners. I just,
Well, I think what Molly
yeah.
did, confiscating it, was a mistake. I think these governments should maybe want to negotiate maybe a higher royalty tax or something like that. But if they confiscate a mine, I mean, all the foreign direct investment, the mine companies will pull out. They won't get any more investment dollars. So you
Well, that's
confiscate
right.
one mine and that's it.
That's exactly right. And so they can't really do that. But you are seeing, I mean, we've got several countries who have increased their royalties for just the reasons you're talking about. I mean, and it is a problem. It's always a risk. Now, I mean, the average ASIC all-in sustaining cost of pulling an ounce out of the ground worldwide, it's kind of in the $1,700 range. So actually, the margin you talked about is actually bigger than 50%. So at 44, so if it costs you 1,700 to mine an ounce and you sell it for 4,400, that's even more than 50%. So the business is just extraordinarily profitable right now, and set to get more profitable because I think when gold right now is in a little bit of a triangle, it looks like it's going to break out to the upside, and the measured distance on that suggests we're going to 5,200. I mean, I think in the next 4 to 6 months. So, I mean, a $5,200 gold price at a $1,700. I mean, good God, man, these things. I mean, that's why I think these stocks just have more to go. I mean, they're up. Yeah, they're up a lot. But this is the way this industry works. I mean, it's feast and famine. It's an extremely highly levered industry tied to the price. And by the way, if ever there comes a time when, all these fiscal situations get fixed and people don't want gold as much and the price of gold starts to get squishy, these miners are going to get killed. They're just going to get crushed. I mean, we
Yeah,
saw
I don't think these governments are going to get religion anytime soon. They
Well,
seem to
that's
want to
right,
be
but I
going the
just
opposite
I
way.
just want to point out the risk because people look at this thing, oh my God, this is just easy money. And yeah, kind of,
Well,
but
we
but
had
I
a
bet
bear market for 15 or 20 years where everyone just made fun of us and said
well,
like
that's my
only
point.
morons buy gold and silver.
That's my point. That's my point. I mean, in 2011, everyone thought it was easy money too, and guess what? That was just before gold price got soft and they rugged us, and all of this stuff just got destroyed. So, I've seen it long enough now to understand that it is cyclical and there are two sides to it. And I'm not necessarily sure I'm going to be holding these things for 10 years. I mean, it's going to be case by case, and we're going to just have to see how things develop. I mean, the good news is, we get to watch what these governments do. And, I mean, if look, if blue team wins in a couple of years and Stephanie Kelton is the Treasury Secretary and UBI, Andrew Yang brings in UBI and the MMT people get control of it. I
And
mean, look
AOC
out.
is president. Yeah.
AOC is president. Right. I mean, gold's going to $40,000 an ounce. Okay. I mean, $20 to $40,000. That's the good news, right? The bad news is, hamburgers would be $150 and gasoline's going to be $20 a gallon, right? I mean, it's right. I mean,
There may
because
not be free speech, and anyone who says anything bad
well,
about
yeah,
the
right. I
dollar or
mean,
gold might
and
be
we'll have a million
imprisoned.
other we'll have a million other social problems because everybody and their brother will be angry and pissed off and doing yeah. No, it'll be one hell of a mess. But the point is that we just can't tell what these governments are going to do, but we can watch very carefully. And as every card gets turned over, you get more information, and you say, all right. I mean, I remember in the beginning of this past year when I was like, oh, Doge is going to save us. We're good. We don't need gold. We're going to balance the budget and money, the basement's
Well,
going to
I
spread.
was telling you to be cautious about that because of how things work in DC, that they weren't going to be able to cut the amount of funds that I mean, they did expose a lot of the stuff with the US aid and the
No,
corruption,
they
but
did.
they didn't
Yeah.
cut nearly as much. They did expose the waste, fraud, and abuse. They just couldn't cut because that's unfortunately how things work in DC, is even when you expose fraud and you expose felonies, that the people who committed the felonies don't end up going to jail, and they just figure out how to move like the charity fraud or the other fraud to somewhere else.
Yeah, no, that's exactly right. I mean, I think very well said. I mean,
Well,
I
I've
mean,
been here 25 years and I know a lot of government employees and I know a lot of
yeah, very well
consultants
said. I
and a
mean,
lot of lobbyists. What?
I was listening to another pod, a friend of mine, and he said, the one thing about Elon is he's not stupid. He tried to do Doge. He got in there. He looked around, and it took him 3 months to figure out this is pointless. I
I,
can't do it.
Well, I spoke to people like it's in the archives there, and I spoke to him in emails too. I spoke with Jack Abramoff for 2 hours. I mean, like
Oh,
people
good.
forget he was the top lobbyist. And I spoke to him for 2 hours on the phone and on like a old Skype call years ago, like 10 years ago, and he straight up told me like he was not the only one doing all that stuff. He was like lots of people,
Oh,
lobbyists,
yeah.
Republicans and Democrats were doing what I was doing. He was like, I just got caught, and they made him an example because he was a Republican.
Right.
So the whole system is there's a documentary out if our listeners want to see it. It's a really old one. It's like from 2008 or 2009. It's called The Best Government Money Can Buy, about lobbying, and it shows that large corporations get thousands of percent return on investment for every dollar they spend on lobbying, and it's the best ROI of anything is on lobbying.
Yeah. No, yeah, exactly.
To add to your points there, Lauren, about the government's, balancing the budget. I mean, maybe an emerging market country, if they get in financial trouble, maybe unless President Trump decides, oh, I'm friends with Malay, here's a swap line that the taxpayers didn't vote on, that Congress didn't approve. But the majority of the U.S. is probably not going to be constrained by that unless the world reserve currency is removed from us.
Well, that's right. I think that's exactly right. But I think it's it's interesting. I mean, people say, "Well, do you think the dollar is going to go down?" Well, yeah, but all of them are going to go down. I mean, I think the real story here is that we are in, for the first time in 100 years. And the last time this happened was kind of around World War I when everyone went off the gold standard. The first time is we're in a sovereign debt crisis, and the governments have proven incapable of managing the currencies. And so, as a result of that, gold has stepped in and is kind of filling the blank. And that's why,
Exactly. And all you have to do, and we were talking about this in past interviews, Lawrence, go and look up the gold price in not just the US dollars. That was actually the last gold price to go up a lot, was the US dollar gold price. Now it's going parabolic, but go and
yeah.
look up the gold price in Japanese yen or these other currencies,
Oh
Australian
yeah,
dollars. It is
The
parabolic.
Turkish, yeah, the Turkish lira, the Brazilian real. Yeah, no, so it is. Look, it is what it is. And all we can do is, we're just sailing on these rough seas. We just adjust the sails. But I feel like, I wrote the book because I wanted people to understand, and I want to show people how broken it is, why it's broken, and then I wanted them to understand how they can protect themselves, and they should try to protect themselves, and then to the degree that we all want to be civically minded, we should basically try our hardest to, support, politicians, Warren Davidson, Cynthia Lummis, Rand Paul, Thomas Massey. I mean, people who believe in restoring sound money to the country, because that's the core. The core of the problem is that the money's broken. That's the title of Lynn's book, Broken Money. And until
And
we fix it.
now they're printing the money to subsidize what the budget deficits and bailouts and social program spending and
Yep,
quote unquote infrastructure or quote unquote national security. It's just going to be probably bailouts for big tech companies or their
yep,
friends.
all of that. So it's an unfortunate set of circumstances, but we are where we are. And they tend to gaslight us and tell us. I mean, I think it's hilarious that Trump recently said we've got no inflation. Right.
Well, I mean, he did a 180. I want to say the first like 6 weeks he got into the White House there in this term, he said he didn't care about the stock market. And I think someone said, look, if you run these policies and you let the stock market crash, the U.S. tax Treasury finances, the tax receipts are going to collapse. I think
I think
someone
that's
explained him the math and be like,
yeah.
then things are going to be even worse.
I think that's right. I think that's absolutely right. And that's why I think he's thinking, Hassett, he wants Hassett because Hassett will take rates down a lot. But the bond market, a lot of people in the bond market have come to him and said, you do that, and we're gonna blow up. And so that's why maybe Warsh is going to get the job instead of Hassett. We'll see.
Yeah, they
I mean,
start cutting rates rapidly, Lawrence. I think we'll see 5,000 gold probably in sub 18 months. We might see it in 12 months if things get crazy enough.
yeah, I think that's right. It's absolutely
Well,
right.
we almost hit 4,400, and so every time people, I mean, there's a bunch of people going on business TV that don't understand any of the macro stuff. They haven't bought your book, they haven't bought Lynn Alden's book. They think you and me are crazy people, and they've been calling tops in gold and silver now since silver was at like $30, $35, and since gold was at 2,500. They've been calling tops every couple weeks, and they won't talk about their bad track record of calling tops on gold and silver. So they've been totally wrong. They do not understand what's actually happening with the macro that you spent the time explaining in your book.
Hmm. Yep, I think that's correct.
Well, why aren't you on business TV more then? So you should be on business TV then, explaining this stuff instead of the talking heads that are pumping up with the AI stocks and a lot of that stuff.
I don't know. I mean, I have no idea. My sense is that the message I deliver is pretty anti-establishment, and therefore the establishment TV people are not going to put me on, and that's fine, right?
Well, I want to thank you so much for your time today. Please tell my listeners more about your gold fund and the Bitcoin Opportunity Fund in your book.
Oh, thank you very much. Yeah, well, the book is called The Big Print. It's available on Amazon. I've sold about 50,000 copies of it, not quite, getting close to that. It's hardcover, paperback, EPUB, and also audio version. I have a website. The company I run is called Equity Management Associates, and we've got a fund that we manage where if you're a accredited investor with $200,000 minimum account, you can invest in the things we invest in with us. And the website is EMA2, Edward Mark Alpha, the number 2.com. You can see all our past quarterly newsletters are on there. They're free. You can actually sign up on there if you want and get us. We'll send you the newsletter. We'll never spam you. So whenever it comes out, we send it out. And then Bitcoin Opportunity Fund is something that David Foley, myself, and James Lavish, and some others, Mark Moss, set up a couple of years ago. And that's similar. It's a monetary debasement fund, but with a heavy emphasis on Bitcoin, not gold. Whereas the fund I run at Equity Management Associates is, 90+% gold with a little bit of Bitcoin. The Bitcoin Opportunity is the other way around. So, and then as you know, and most people know, I'm a big loudmouth on Twitter. I'm no fan of the central banks. I think the central banks are really what's caused all this trouble. This all, for me, this all kind of started and grew out of, Ron Paul's movement back in 2008 to end the Fed. And he wrote a great book with that title, End the Fed, which it's kind of old book now, but it's still very, very relevant. I reread it as I was writing my own book, and I recognized just how many things in there he had absolutely right. So go back and pick up Ron's book. If we could end the Federal Reserve, I think we could make the situation much better.
Well, it looks like the Fed's going to be any faked veil attempt to say that the Fed's independent. I mean, it looks like Trump's going to merge that with the US Treasury. He's going to install a puppet Fed governor that's going to do whatever he wants. So at least this term for Trump, potentially it could be even more bonkers with interest rates cut and bailouts and debt monetization and QE, or they won't call it QE. I mean, like we've seen that with the repo crisis from 2019. It looks like the Fed's following the same playbook now. They're not going to call it QE, but the Fed's balance sheet's going to increase. They're going to give the commercial banking system reserves. People forget, so everyone calls it, publicly the nickname, right? The Fed is the Federal Reserve Bank. So one of their priorities is the reserves of the commercial banking system. I have to keep reminding, professional money managers this. They seem to forget that point.
Yeah, that's absolutely right.
So it's just really sad that that's one of their priorities because they just keep repeating, the talking points that the Fed only cares about inflation and employment. But even Jerome Powell just admitted, I think he looked it up on ChatGPT. He looked up a way to dance around the word stagflation, right? Because remember, he was saying, 12 months ago or something like that, that there wouldn't be any stagflation. But then didn't he just admit a couple of days ago that there was stagflation?
More or less, but he didn't say it in those terms. Yeah.
Well, yeah, I mean, like, I actually would have respected him more if he said, "Look, we screwed up. There is stagflation now. There's higher inflation than we thought. There's unemployment in the real economy, with the visa applications and companies are firing because the consumer's not spending, or AI automation is causing people to lose their jobs." I would have respected him more if he actually admitted, mea culpa, we screwed that up.
Yeah, I agree with you. I mean, he has said a couple of times that he's in a real pickle. I mean, he's indicated that.
Yeah, I wouldn't want to be Jerome Powell. If I was him,
No.
I'd be
Oh,
happy to
yeah,
retire. Yeah.
you can tell. I mean, he is just he regrets the day he took the second term, and May can't come fast enough for him, is my view.
Yeah, I totally agree. He just wants to go relax and go watch his Washington Capitals season
Right,
tickets
right,
at the
and
home
yeah,
games.
and declare and say that he did the right thing when he was there. Yeah,
Well, that's how
exactly.
every high level official in DC claims that they didn't screw things up.